Welcome to Thursday, December
14th.
14th, past 7 p.m. for Real Estate Accredited. I'm one of your hosts, Jeff Rodriguez with Philippe Schuligan. We are intending to deliver educational information on this platform. So anytime there's anything of interest or a topic of discussion that you would like to go, we always encourage folks to send us an email and so that we could cover it. Today, Philip's going to go over a topic of discussion. And yeah, so go ahead, take it away, Philip. Thank you.
Thank you, Jeff. Yeah, so today we are going to talk about past performance is not a guarantee of future investments, sorry, or is it? And as usual, in this call, Real Estate Accredited, our focus is on in-place commercial multifamily value add, just to give a little bit of context. And feel free to ask any question throughout. We want this to be interactive. But I guess so the number one question regarding um, past performance is like what's the best way to gauge that? And I think the most interesting way to look at past performance or performance of an investment is the internal rate of return. And I have provided on the right of the screen here the formula, which is basically a relatively complex formula, but that involves the net cash flow during the period of holding the asset, and as well as the initial purchase price. And as you can see here, the IRR is going to be a factor part of that equation. But to make it simple, the simple definition that I put here on the screen is the internal rate of return, or IRR. It's a metric used in financial analysis to estimate the profitability of potential investments. It's the book definition, but in more layman's terms, the IRR it represents how hard is your money working for you. So how to implement that in the day to day practically was just you can use a spreadsheet software, whether it's Excel or Google Sheets, and use the IRR formula. This a little screen capture that comes from the Google Sheet, but I added an illustration. Very simple case. I took the example of a 10% cash on cash deal over 5 years, returning a total of 100%. So in other words, double your money throughout the hold. So you can see initially or year zero, you're going to invest 100,000, for instance, get $10,000 of cash flow every year. The proceeds from the sale will be 50,000. So now you are 50,000 plus 50 in total returns, or double your investment. And then if you add up all these numbers throughout the different years, that's what it looks like. Minus 100,000 year zero, the 10,000 every year, and year five, 10,000 for cash flow plus 50 from the sale plus 100,000 of return of capital. So that's 160. Now, if you do the actual formula to obtain the IRR, which is 17.1%, so you very simply type in that cell in B10 equal IRR parenthesis B6 column G6 and close parenthesis, and you're done. A little tip here on actually a note: if you're looking at past performance, you're going to need to have the deal done a full cycle. Obviously, you need to have the disposition and selling the deal to see all the numbers there. Okay. So here actually we wanted I wanted to share, for instance, a track record, which happens to be our track record. And so how you take a look at that from gauging and looking at past performance of a particular operator, for instance. Well, you're going to look at multiple full cycle investments. So where there was going from purchase to disposition. And you're going to look at how did the deals perform compared to their pro forma. And here, for instance, I'm showing 3 deals, past deals, with the target IRR ranging from 16 to 18%. And actually, some performed a little bit better, some performed, one of them a little lower, and one much better. I think that's just the reality. It's always good to see a lot of good positive numbers, but I think in the reality, sometimes some deals will do better, sometimes they will do less as good. But I think if you look from an average standpoint, we've done okay. And I think from that standpoint, every deal I can tell you what we learned going through the deals, always getting better from that standpoint. All right. So now we learn about what to look for. And again, I think the IR is the best, and what to look for in the past few full cycle deals. But now let's say, okay, you have a good track record, or you find an operator who has like the solid numbers there. They've done several full cycle deals and everything is in line. But so it gives you confidence to invest with that group. But now, what are the factors that can affect the future performance? And so those factors, I have several of them, but the number one, I think, and that's the most critical, I would say, especially these days, is the macroeconomic factors. Meaning, and here I'm showing as an illustration, at the bottom, you see the line in blue is the CPI, so the inflation, in other words, and the line in red is those are the interest rates, right? And as in the past couple of years, interest rates have risen considerably, which in turn has affected the market quite a bit. And during our past calls, was showing the effect of adding 0.1% to the cap rate as an exit to be able to compute the exit. And people who purchased properties at the end of 2021, if you're going to add the 0.1% per year rule, you'll be at 5%. In 5 years from now, we might not be in that position of being at a 5% cap rate anymore. And by the way, this blue line is presenting cap rates in Dallas-Fort Worth. So my point here, just to give an illustration, when people were in this time frame where cap rates were compressing and there were a lot of demand, a lot of offers, was very competitive, everybody was buying left and right, there was no expectation of such a strong turn in interest rates. There are people who are in trouble right now with deals, right? Because they were purchased in that period that it made sense to put offers at a higher price and interest rates were low. But if there's no, like also we spoke on one of the calls, if you didn't buy a rate cap on a bridge debt that has variable interest rate, you're in a very tough position right now. But again, it was for a period of time, there was no particular reason to believe that anything was going to change, which now, obviously, I think the general advice is like stay away from variable rates, stay away from bridge debt. But there are situations where you don't really have a choice. So I think, but using bridge debt, right? So in that case, what you want to do is work with your lender on a fixed rate bridge debt that exists. That's something you can ask. So always, I think in terms of underwriting, best practice is stress test your model and try to think about different outcomes. What if there is a recession and then occupancy is going to be lower, or at least economic occupancy? It's like who's paying the rents? What does that mean? How much can you survive at 50% occupancy or 60 or in those range? I think a good rule of thumb is in the 70%, I think typically what I've seen. If you can sustain that, you're in good shape. What are also the effects? The effects of interest rates I mentioned, right? The recession and effects on occupancy, at least economic occupancy, and other is like just if there is a recession, it's likely that you're going to have your rents are going to go to be lower as well. So it's the same thing. Stress test your model from that standpoint. I just want to take a sec to welcome Carl to the call. Thank you for joining us. Today's topic, Carl can go back one sec. Past performance is not a guarantee for future investments, or is it? So that's what we're talking about. And, we're talking about IRR, the internal rate of return being the gauge of that performance. And now we're looking at the reasons where that make hard to predict the future of deals. So on the next page here, there are other things that are worth mentioning. I think besides the macroeconomic factors, there could be market-specific conditions. And I think a good example for that I always mention to my students is if you take Detroit, when the automobile industry started to have some troubles a few years ago, there was some trouble definitely in the city of Detroit. And as a result, I think the real estate suffered quite a bit. And so the takeaway from that, like you want to avoid markets that are too dependent on a single industry. So that's why we always look for multiple employers, multiple industries. And that's why it's very important to have larger markets that you're looking at where there are multiple industries represented and multiple employers. That's one way to be able to hedge against the market specific conditions. But again, in general, go ahead, Jeff.
If I may, we do talk a lot about major industry moving from one state to another, big companies. But so in my area where I'm in the DC area, there's a lot going on. For example, here recently, there's a congressional hearing because a GSA individual decision maker in GSA picked an area in Maryland where the new FBI headquarters is going to be. There was uproar because all the DC, Virginia, Maryland area, they're always fighting for these type of moves, these type of like headquarters to be where it's going to benefit them. It's not a Tesla power plant or battery, manufacturing facility. It's things like that are just that a lot don't pay attention to that. FBI moving its headquarters to a new area. That's a lot of income. That's a lot of capital. That's a lot of movement. Owning properties in those certain areas. If the headquarters leaves to wherever they used to be, that area is going to lose investments. That area is going to lose renters, personnel. Same thing with the Washington Wizards and the Washington Capitals. They are right across the way in DC, and now they're talking about moving into Virginia. A 30-minute difference. But there is so much discussion of DC downtown DC losing a lot of money, restaurants closing, and people not wanting to rent or live in that area because of them losing such a big income producing sports teams would definitely change the dynamics of that area. And so it doesn't even have to move that far away. So there's like a lot of little facets here and there. People are already looking to buy in that Virginia area, put in money because that's where the money's going to go. And in regards to like the market's conditions, there's a lot of like things like that I think are easily overlooked when it comes to where should I invest, where should I put my money, the path of progress. That's what it boils down to as well. So I just want to kind of throw that out there. That's happening right now.
Which, that's like kind of policies or political decisions. And that's a good point. And I remember like on my first deal in Memphis, we were supposed to, like, one of the points, like they were going to build a convention center like 3 miles away or something, and they had a space and so on, and it was like there were press announcements, and that was after, I forgot, right before after we closed. So it was not like a major factor decision to go, but we are like, oh yeah, that's great, that's a benefit. And sure enough, during our 5 years of holding the property, they didn't even break grounds. So see, that's another thing, like, don't necessarily buy into, be careful with the path of development, because is it like actual development that's happening, or is it possible development? There was another deal we are looking at in Georgia a few earlier this year, and they were like, yeah, there's going to be a factory of this competitor of Tesla. I forgot the name of that company. And sure enough, they didn't break grounds yet. It didn't happen. Like, there were like people protested, and because they were going to receive too many tax breaks and whatnot, and they created a big commotion. But it might be years until it happens, if ever. It's not. Those are not good reasons necessarily. You have to be very sure of what's going to, are things happening, or they may happen. That's one of the things you want to check there. So next on the list, we have property specific factors. I think, for instance, we are doing a lot of garden style type of properties. I think that's a very typical, at some point, how the typical maintenance type of things that happen on these properties. But for instance, when you start going into a high rise, it's a little bit different, right? So now you're going to have an elevator or two to take care of, and there will be like fire safety, additional expenses, etc., etc. I think if you always want, and I think any good sponsor will address the specific property specific factors, and then you want to make sure that how did they address that, how much did they research. Now we're buying a deal on a in a coastal area that it's subject to hurricanes. It's like, how is it built? How close are you from the flood zone, and etc., for instance. But those are you want to make sure that you have the answers to these questions. Similarly, but with a little bit of a nuance, what's the investment strategy and business plan, right? Because if you're buying, let's say, core plus type of deals, meaning that they are basically stable, but there's an opportunity to add value, right? So you'll be able to get long-term debt from agency, because that's what they look for. And when you do regularly deals of that nature, that's something you're going to be able to have experience with. And if you look at a very different business plan, such as a heavy value add that we're now, because, for instance, the deal is not stable and there's low occupancy, for instance, and there's a heavy rehab to be done. So you have to take bridge debt. So now again, we just discussed that earlier during the macroeconomic factors. You have to be sure, you have to know what you're doing if you're going to take bridge debt with a variable interest rate, and you have to take a rate cap, so to avoid the volatility of the interest rate. And that's definitely, it's more advanced strategy. So if the sponsor is doing that, and they've done that before and they've been successful, like the odds are in your favor. If it's like a first time, now you're taking a chance. And more in general, it's like my last point, management changes. By that, what I mean is, are they going to work with a well-known property manager that they've worked with before? We always try to stick to a recipe, basically, that we know works and we have experience with. And that's something that we're going to pay attention to, particularly when we work with other groups there. How do they address is there any change from the market specific conditions, or property specific, or investment strategy business, or are they going to work with a different property manager? That's something we're going to ask them. What's the change there? And sometimes, and I know, for instance, we're currently working a portfolio located in Houston, and there is a change in the business plan compared to a typical business plan. And that change is very interesting, but it's also very straightforward. So the change, again, like the typical business plan, you buy an asset, you're going to do renovations, value add, and that's how you increase the value. And at the end of the cycle, you're going to sell it to a REIT, for instance, who is going to look for something very stable. And in the 100+ unit range, our buyers were looking for stable assets. So the exit from that standpoint is pretty straightforward. But here, in this particular portfolio that we're working on, and it is located in, like I said, in Houston, Texas. And Texas, the property taxes are very high. What we've done at that particular deal is that we work with the housing authority, and in exchange of limiting half of the rents, which actually has a marginal effect on the rents at all, like a few percent, year one, we're able to save 100% of property taxes, which is like, it's a very straightforward, it's like day one, right? So you're closing on that deal, day one, we're going to save $500 per unit thanks to this tax break. In that particular case, like the business plan, even though there is a change, but the business plan is such that it makes it a very appealing proposition there. And again, when you're going to underwrite and take into account the effects of that particular strategy and the limitations on the rents and so on I mentioned earlier, at the end of the day, even if you have to lower your rents of 2-3%, when you're going to save $500 per unit day one, and I think it's a winning combination. And by the way, at the end of that deal, the buyer will be able to benefit of, I think, 90% of the tax saving. We're going to benefit of 100%, but the buyer at the end, they would get 90%, which is meaning that at the exit, it makes the deal also very appealing.
Be honest, like most deals don't start off day one already profiting, because it takes a while to increase those rents unless there was something already in the works. And this is day one. The benefit is immediate versus waiting to turn new properties and get another 25, 30, 50, $75 on an additional asset.
Right. So the tip here is again to in order, and I would say in general, obviously, like we just mentioned a case. It's not necessary. It's a change in a good direction, but I would say in general, you want to work with experienced team who are going to address the macroeconomic factors with the stress test, like I mentioned, and who are also very experienced in a given market, doing kind of the same type of deals all the time with the same property management. So that's why that's the type of deals that we're looking for ourselves, very experienced sponsors to work with, very knowledgeable in a particular market, and we're using very similar strategies and with the same property management company. So the tip is like minimize changes, and now your odds of being able to replicate the returns are going to be better. So that's all I had for this evening. I know I see Lawrence joined a little bit later. The topic of the day was past performance is not a guarantee for future investments or future returns, actually. That's not with future returns. Or is it? That was the topic of the day, and we discussed the IRR, internal rate of return. We discussed how to compute it in a spreadsheet, gave an example of a track record and how to look at that. Okay, thank you, Brandon. Take care.
Bye, Brandon.
And,
Merry Christmas.
Merry Christmas. And then we was basically, we had this last page. I see, yeah, Carl sent me a direct message. Let me send you a link, Carl. So you can set up a call if you want. Give me 1 sec. But otherwise, is there any questions or comments?
There's no questions, comments. We thank you for showing up. Time is limited, but if you have any questions or want to get in contact with us, how to reach us, we're always available. Always here to put our best foot forward and provide value. And I think, Philip, you had the opportunity to drop your.
Yeah, I provided my link to.
Okay. But yeah, thank you for taking time and hanging out with us this evening. I hope everybody is already done shopping for their loved ones for Christmas and everything's squared away. I hope everybody has an excellent holiday season. I don't think we're going to be meeting up next Thursday. I'm going to be out of the country, but
yeah, I'll try to do something. I'll try to do something. So I'll find something to discuss. Yeah, you're welcome. Everyone welcome to join.
So, all right, gents, thank you for your time and look forward to seeing you next time.
All right. Thank you, everyone. And Carl, I sent you an email as well with my link. So hopefully you can find a time that works for you. Otherwise, let me know.
All right. Merry Christmas, everyone. Bye.
Thank you, everyone. See you soon. Take care. Bye.